Hi everyone. Let's talk about what stocks, ETF, mutual funds, and index funds are and how they're different. Everybody's investing style is different, so you need to know what these investment vehicles are to make the best decisions for yourself. This is going to be a super beginner-friendly video, so expect a casual, friendly, conversational-like video. It's the best way to learn. Let's get into it. Firstly, I think it's important to start off with the basics. What a stock is. The best way to explain this at a beginner level is that a stock is what people call one single company that you can buy in the stock market. For an example, Microsoft stock, Tesla, Apple, Amazon. A stock is one single company. And when you buy a stock, you're actually buying shares of a stock or shares of a company. You can think of a whole pizza as a stock, and each slice represents a share. And big companies have billions of shares for the public to buy. And when you buy these shares, you own a portion of the company. For an example, the company Apple has over 15.6 billion shares. As of December 13, 2023, you can buy one share of Apple for $197.96. Obviously, the principle of investing is to buy low and sell high. So your goal would be to buy a share of Apple at $197 and sell it in the future for a much higher price. 5 years ago, a share of Apple was around $40. Now it's almost at $200. If you had bought $10,000 worth of Apple 5 years ago when they were $40 a share, that would give you around 250 shares. And if you sold all 250 shares today at $197, you'd get around $40,000 in profit. Pretty straightforward, pretty insane. Now that you know what a stock is, it'll be so much easier for you to understand what an ETF is. ETF stands for Exchange Traded Fund, and it's essentially just a basket of stocks all in one. A stock is one single company. An ETF is hundreds of companies in one. What's great about ETFs is that you can buy shares of an ETF just like how you can buy shares of a stock. That's one transaction and you would own hundreds of companies all in one go. A popular example is the Vanguard S&P 500 ETF. That ETF holds the top 500 companies in the US. Now, just like a share of a stock, you can buy shares of an ETF. And that single share will give you ownership of 500 different companies. For an example, if you buy one share of the Vanguard S&P 500 for $112.86 as of December 13th, that money just gets divided into 500 different stocks. Some companies in this ETF include Microsoft, Apple, Amazon, Tesla, and 500 others. So you won't own full shares of these companies, but you'll own a tiny piece of a share. These are called fractional shares. Just a fraction of a share. There are other more niche ETFs like the BMO Equal Weights Banks Index ETF. So if you like Canadian banks like TD Bank, RBC, CIBC, etc., instead of going and buying all the banks separately, you can just buy that ETF where they already hold 6 different banks. So the difference between a stock and an ETF is that when you buy a stock, you're putting money into one company, and if you're buying an ETF, you're putting your money into many different companies. Before we move on to mutual funds and index funds, let me tell you why ETFs are better for beginner investors. First reason is diversification. If you only had $10,000 to invest, you don't want to put all $10,000 into one company, because knowing which company will do well or not is nearly impossible. So you'd rather divide the $10,000 into 500 companies and buy an ETF. So even if one company does poorly, you still have your money in 499 other companies. Don't put all your eggs in one basket. Second reason, you get diversification at a low cost. ETFs will charge you MER fees, management expense ratios. This fee is for ongoing operational expenses like record keeping and administration, etc. The Vanguard S&P 500, like we talked about before, charges you 0.09% in fees yearly, which is peanuts. That's only $9 a year if you have $10,000 in that ETF. I'd rather pay $9 to own 500 companies than to log into my brokerage account and hit buy 500 times. And also, some brokerages charges you every single time you buy a stock. The brokerage I use is actually commission free, so you can buy and sell stocks absolutely for free. I'll link it below. It's called Wealthsimple, and no, this isn't sponsored. So to recap again, a stock is one single company and an ETF is hundreds of companies all in one. And it's always better to have your money in different companies. Diversification is super important to any investor. Now let's talk about mutual funds and index funds. Now before you run away because they sound confusing, I'm going to make it super simple. Also, to be transparent, I've never owned any mutual fund or index fund. I only buy stocks and ETFs, but for you, it's still good to know all the options because your lifestyle or your willingness to be more or less risky might be different than mine. Mutual funds and index funds are also a basket of stocks. So imagine an ETF, but there are two styles of that ETF. One style is what's called actively managed. The other is passively managed. So there are actively managed basket of stocks and there are passively managed basket of stocks. Actively managed means that there's a professional fund manager that actively buys and sells stocks to try to outperform the S&P 500. Passively managed just means that there's no fund manager actively buying and selling stocks to try to outperform the S&P 500. These terms are important because remember those MER fees that we talked about earlier? Obviously, actively managed funds have higher MER fees. You need to pay a fee for someone to actively manage that fund. Mutual funds, 99% of the time, is actively managed. So if you want someone to actively buy and sell these stocks, you have to pay them a fee to try to outperform the stock market. The MER fees for mutual funds range between 1 to 3%. And I know what you're thinking, only 1 to 3% to have a professional sell and buy stocks? So worth it. Well, you might be wrong. Investing $100,000 over 20 years with 1% MER fees means that you're paying around $80,000 in fees. Versus if you're only paying 0.09%, that's only around $7,000. That's a huge difference. Fun fact before index funds, Warren Buffett made a 10-year, $1 million bet that actively managed funds will underperform passively managed funds. And Warren Buffett won. Like I said before, knowing which stock to buy and sell is nearly impossible, even for professionals. Index funds are super easy to understand. They're basically like ETFs, but you can only buy index funds once a day after the stock market closes. With ETFs, you can buy them when the stock market is open, just like how you could buy a stock. So you can buy or sell ETFs anytime. And with index funds, there's usually a $1,000 to $5,000 investment requirement. So you can't invest less than $1,000 if you want to buy an index fund. But index funds can sometimes have lower MER fees than ETFs. So just ask yourself what's more important to you. A, do you want to be able to sell and buy whenever you want? Those would be ETFs. Or B, do you want to invest $1,000 or more at a time or less? I had so much trouble understanding these investment vehicles when I first started investing at 19 years old, so I really hope this video helped. Also, make sure you subscribe to the channel and like this video.